Today, I want to talk about something super practical. How to configure out how much debt you can actually afford. We're going to cover two key concepts, your living remainder and your debt ratio. Let's dive in. Before we start, here a quick roadmap of what we'll cover. In the first place, we will speak about what are living remainder and debt ratio. Secondly, let's take a real life situation where these tools matter. Third, step-by-step mathematical calculation. Fourth, let's take a concrete everyday scenario. And the last, how to get the most outfit of these tools. Explanation, definition and formulas. What is living remainder? Living remainder is the money left after paying all fixed expenses. What you actually lived on. Living remainder equal net income minus fixed expenses. What is debt ratio? The percentage of your income that gets toward debt repayment. Debt ratio equals monthly debts divided by gross income multiplied by 100. If your debt ratio is under 33%, you have a comfortable zone. But if there is between 33 and 40, you have a warming zone, a caution zone. If your debt ratio is higher than 40%, you are in danger. Lender usually reject it. This is an example of a pie chart showing where is the safe zone, where is the warming zone, where is the danger zone. When and why to use these tools? If you like to taking a mortgage before buying a home, background debt check you should do before day 2. Financing a car, auto loan and to your monthly debt, calculate the impact beforehand. Requesting a credit card. New credit line affect your capacity. Know your limit first. Student loan. Future debt repayment reduce your living remainder. Plan ahead. That means calculate your salary estimate after learning before do your demand of student loan. Career change. Income dropped. Recalculate immediately to avoid over indebtedness. Major purchase. Split payment or buy now, pay later. Still debts. Calculate first. This is a graph. Show how often are this calculation needed. Let's take an example. Theoretical example. Living remainder calculation. This is the given information. If you get a monthly $3,500, this our rent 1,000, car loan 350, grocery and utility 400, insurance 115, subscription music 100. So make a calculation. Your fixed expense is 2,000. So your living remainder is 1,500. After calculation, to interpret your living remainder, you have 42.8%. So you are in a healthy life remainder. This is a bar chart. Show you what is your expense and what is your net income. Let's do an example about debt ratio calculation. Using some profile, gross monthly income 4,000, totally month debt 1,350. Debt ratio formula, month debt payment divided by gross monthly income multiplied by 100. So we have 33.75%. To see what is the verdict, you are in a caution zone because your debt ratios is inside of 30% to 40%. So you are in a warming zone. This case is risky. This is a graph, a bar chart show you about your debt ratios with thresholds. This is a real life example. Sarah wants a new car. This is the profile of Sarah, the world data information. She gets 3,200 a month. The rent 900, the food and grocery 350, utility and phone 150, existing credit card 200, Desiree car loan 450 by a month. So after calculation, we get her expenses, the sum of his rent, food, grocery, utilities phone, existing credit card, and the zero car loan. After calculation, we get 1,600, the rest of her net income minus her expense. After car loan, new living remainder, we had 1,150. It's very tight. The debt ratio is 48.4%. You are in danger. So don't do this. This is a graph showing a Sarah living remainder before and after car loan in a dollar. The blue, the living remainder, and the red is the minimum recommended. Let's making these tools work for you. First, keep debt ratio below 30%. Set a living reminder floor. Recalculate every 6 months. Pay off small debt first. Simulate before you see a contract of a debt. Include all debt type. This is a bar chart show you an average debt ratio reducing by strategy. The K formula and the threshold. Living reminder aims for higher or equal 30% of net income remaining. Debt ratio maximum 33%. Target less than or equal 30%. This is a small table show you how to calculate and view your living remainder and your debt ratio. And this is a sample graph to our debt ratio journey to target 6 months. Let's take a rule to remember. We have 3 rules. The one, always calculate before borrowing, never seeing anything without running both formula first. Second, keep debt ratio under 30%. 33% is the limit. 30% is the smart target. 25% is your goal. And third, protect your living remainder. Set a floor and never go below it. Your quality of life depends on it. If you'd like to have an ideal budget distribution in your life, don't hesitate to use the 50-30-20 rules. That's the lesson for today, guys. Thank you very much. If you have a question, don't hesitate to write in the comment and subscribe in our channel to have a new notification and to help me to create a new content. See you soon.